Welcome back once again to today's session with AssetPlus Academy. It's so nice to see so many of you joining in each and every Saturday morning. That's the spirit that we all need in the mutual fund industry right now. So today we are going to be talking about mastering mutual fund distribution in India. And so today we are going to talk about why the mutual fund distribution industry is not just growing but exploding, and why this is happening, and why this is actually the perfect time for each and every one of you to build as well as scale your mutual fund distribution business. And to break this down for all of us, we have someone who understands this industry inside and out, Mr. Sunil Subramaniam. With his rich experience in the mutual fund world, he brings insights based on real numbers, real trends, and real on ground experience. So, we are also truly honored to have him as the strategic advisor for MFD growth at AssetPlus Academy. So, without further ado, we'd dive right in and get started. And as always, feel free to drop in your questions in the chat box. We'll take them up at the end of the session if we have the time. Thank you so much. Over to you, Sunil.
Thank you, Suganya, and good morning to all of you. Thank you for dialing into this Mastering Mutual Fund Distribution webinar. So basically, this is intended for both those who are aspiring to become MFDs as well as for the existing MFDs in terms of looking at the business opportunity and seeing whether you're maximizing it and are you doing your best as a mutual fund distributor to master the business and naturally then grow your business phenomenally. So first, let me spend a few minutes in laying out the opportunity, right? So this is one of the fastest growing sectors in India, right? Incidentally, you would have seen that the asset management companies which are listed, their stocks are also among the best performing stocks in the industry. So look at the key figures. We are at about average assets about 83 lakh crore and as of close of February, this is 82 lakh crore. And over the 10-year period, that's a 6x growth, and that's a 2.5 growth over the 5-year period. And if you see now, in terms of the total folio counts, I know people have multiple folios, but it's touched 27 crore. Those are 27 crore people may have chosen to invest in 5 different folios, but still it represents a significant number in terms of those. And of these, the retail schemes are all already 20 crores. So, but with all of this growth, we still have a long way to go. Why? Look at the list of the top 10 countries by mutual fund AUM. We are nowhere near them, right? So where does India stands? It's at whatever 80 lakh crores as of that date, a month or so ago, much below the top 10. But we are now growing rapidly, as you saw from the previous slide. So the aspiration is that our country must get to the top 10. We say we are the 4th ranked GDP and all of that, but we have to be also 4th ranked in the mutual fund business, right? So, and if you see then as a percentage of GDP, we all know about our GDP growth rate. Last 10 years, we have grown 10 times. We are the 4th largest almost right now. But mutual fund AUM as a percentage is only a quarter of the global average. This slide shows it's about 20%, 21%. The global average itself is about 75%. So we're only about a quarter. So that's why I say long way to go. So the glass is not even half full, it's only quarter full, but it's rapidly filling up, right? Then the next point is that the GDP growth of our country. You can see the key countries here: India, China, Germany, Japan, US, which are all the bidding for the top 5 countries, right? Now there, if you see, red is Japan declining, purple is Germany declining, light blue is China, which went through a rapid phase from 2000 to 2021 until COVID. After that, the growth rate has slowed down and it's projected actually to then start sliding down in terms of contribution to world GDP. But the country which is rising, right, is the yellow. And since it's not a line, you might have missed it. It's the bar charts in the low. So can you see, we are the consistently for the foreseeable future, the fastest growing, and our share of world GDP is said to go to 19.6% of the world's GDP, right? So already mutual fund penetration, we are low, but if the GDP is going to go so fast, then the mutual fund industry, even if it retains the same 25% share of GDP, is on a phenomenal growth path. But obviously, all of us put together, we aspire for the share of that also to come up to the world standards, right? So, and then when you look at it, ultimately it's a function of the stock market, right? Now we are a 4 trillion economy and we are about 4% of the world stock market, whereas if you look at the share of the world, we are at about roughly 127 trillion, 4. So we are about 3% of the world stock market. But in terms of the growth of the world, 130 trillion GDP, we are 4. So the point is that the US dominates. It has only about 30% of the world's GDP, but it has 50% of the world's stock market. So clearly, US is a darling of everybody in terms of the safety, security, and everything. But we have to, the stock market share of the world is also going to go up along with the GDP. So the mutual fund industry has to keep lockstep with that, right? So that's what I have said. So if you see, I said that the mutual fund has shown a phenomenal growth, but in terms of as a percentage of the stock market, so you can see the multiple layers here. We have grown very fast, but the growth has 3 components: the GDP growth, the market cap to GDP growth, and the mutual fund share of the market cap, or consequently of the GDP growth. So this is the mutual fund share of the market cap. And if you see at the bottom, the second dot, from 2010 to 2025, over the last 15 years, from 3.9% of the stock market, the mutual fund industry has tripled to 10.4%, right? So we are one of the fastest growing segments in the country, but there's still a long, long way to go. And as you can see, 33% of the market is held by the promoters, which is not, and FPIs own about 17%. But if you take away all the promoter holding, the government holding, it's almost double of that. So the key point is that the mutual fund industry has to aspire to become on a standalone basis as much as the FIs, if not better, for us to defend our stock market against an FII outlook becoming positive, negative, right? So that's the story of it. We are already a very fast growing, but we need to make sure that we grow much faster, and we're confident that that will happen. And hence, as a new MFD, if you're looking to join this, right, you are on a train that has just crossed the first stop at rapid speed and is now going to get into the highway. And so it's absolutely the perfect time for you to enter the industry from that perspective, right? And what is the key success factor, I would say, is getting people from their monthly incomes to commit money into the stock market through the SIPs mutual fund, because that is a sustainable one, right? Because if somebody takes a 10-year SIP and that money comes in, yourself, the industry, the country, everybody is assured of that money coming in. And that's the thing which is going to help the share of the stock market as well as share of the GDP to grow up. And it is the efforts of the MFDs which are contributing to this rise. So you can see the journey from January 2022, where we were about 11,000 crores per month, to now when we have happily crossed 32,000 crores per month of SIP. So this is the journey. So obviously the SIP is a key tool in every mutual fund distributor's arsenal, because you get to build a long-term relationship. As long as the SIP is alive, the customer is going to be engaging with you, and your then ability to increase your market share with the customer will go up. So the SIP shows again the same thing, phenomenal growth path in the past, but opportunity to grow phenomenally in the future. And I would love to see the day when this becomes 100,000 crores a month and not just 30,000 crores a month, right? So, and if you now look at the current year, right, or talked about over a long period of time, the industry is on a very, very strong wicket. This year, 2025-26, which just concluded, you can see on an average, we got 28,000 crores of inflows into the market. How much? 28,000 crores. And that's roughly the SIP. SIP amount is averages 29,000 crores per month, right? So it's the SIP which is sustaining the industry. The lump sum, people will book profits from their past investments. People will do asset allocation, so that varies. But then there's also not just about equity. It's also about a significant portion, because it's 1/3 almost of the equity AUM is the debt hybrid flows. So they are an important part of your arsenal, that when there is volatility, hybrid funds are one which come and help you manage the relationship with the customer. And it's also suitable for a particular type of customer. So it's important that you look at it. So put together, the industry has delivered 4.5 lakh crore of cash to fund managers and to the stock market. So the mutual fund industry is a powerful force today in the country against the FIS, which you all know have been consistently selling in our market, right? And the other aspect is to get a sense of the kind of products and where customer money is going, either through a distributor's advice or through customers' desires. And there you can see that of the various equity categories, flexi cap dominates. So 1/4 of the flows of the industry this year, that is 25-26, have come in the flexi cap category. So people would love to give the fund manager the flexibility to choose large, mid, or small. That's number one, right? So that's where the alpha generation happens in terms of a choice of how much do I put in large cap at this point versus mid and small cap. Second is actually mid cap and small cap are equal at 15%. So there's equal amount of people who are willing to take extreme risk of the small cap and slightly lesser risk of the mid cap. So put together, these three segments are a huge component, and not very far behind is the large and mid cap. So you can see that these four products, 25 plus 13 is 38 plus another 30, 68. So 2/3 of the flows accounted for just these four products. All the rest are just making up the numbers, right? So point of view is from a new mutual fund distributor, these are the products on where you got to become an absolute master to know, because that's what they're selling in the market, and the way you go and pitch those products, everything has got to be important. Shifting focus to the hybrid segment, there you can see again overly dominated this year by the multi-asset funds. No reasons, no prizes for guessing why. It's because of the gold and silver component. So 62% of the hybrid category flows have come from multi-asset funds. So as a distributor, you have to learn what are the different type of multi-asset different fund managers manage. How do you pitch the gold and the silver? So knowledge is key in mastering mutual fund distribution, knowledge of this product category. And again, just like mid and small caps, so 15% each, you have the aggressive hybrid and the balance advantage, which are roughly 15% each in terms of the flows, right? So these 1, 2, 3, 4, and 5, 6, 7 product categories account, I would say, for a huge proportion, more than 80% of the industry's flows. And that's where you have to become the absolute cat's whiskers, right? Now, obviously, the future is bright, and we can see very shortly. Originally, we had set this target by 2030, but we are already at 82, 83 lakh crore. I don't think that it's going to take till 2030 to do that. We should be able to, on the strength of our flows and post-war bounce back in the market, to easily achieve this well before 2030. Maybe by 2028, we should be hitting a 100 lakh crore. That's a 1 trillion business, right? The mutual fund industry. So that's the overall landscape that I wanted to point out to you. So let me get into the actual distribution piece, right? The opportunity in the distribution, where does it come from? It comes from the penetration. We are abysmally low still. I showed you the growth, painted a picture of fantastic growth of the industry, but despite all of that, today we have only less than 6 crore unique mutual fund investors. I mentioned 20 lakh folios, right? But that's because of multiple counting of people's investments. They open new folios. But if you take out all of that and do it by PAN, it's only 6 crore on a 140 crore population. We have double the number of active stock market users. We have 3 times the number of actual demat accounts, right? So there's a huge potential just because of the penetration. We are in a fast growing industry, which means it has caught the flavor of the people. It's got people excited. Both SIPs and the Amphi campaign of mutual funds has caught the imagination of the people. It is the distribution force which has to go and exploit it and scale it up. So the opportunity lies essentially from an underpenetration, right? Now, this underpenetration comes from what? Underpenetration is 2 things. One is people who are not even touching mutual funds, which is 135 crore people. Because only 6 crore people out of 140, 141 crores is touching. Second is that even within your customers, those who are already a mutual fund customer, the allocation of funds is very small to mutual fund. So if you see the household savings and look at it, the first slide, 2016, will tell you that 56% then was in property, right? 13% was in gold, right? And bank deposits. So if you see clearly from there, people feel that real estate is the best hedge against inflation. And they feel gold is the best protector of uncertainties. And bank deposits are the best one giving assured returns. So this thought process has dominated people's minds, and only the balance pie is left for equities and mutual funds and all of that. This is 2016. What is the situation changed today? If you take that 56, that's dropped to 51 as a proportion. So clearly real estate has given up some space. Gold remains at its 15%, slightly improved in fact. Bank deposit remain. So the real estate piece is the one that has given up space to the mutual fund industry. So you can see that out of 100 rupees, earlier 56 plus 13, 69 was in physical assets, which is real estate plus gold. Today that is 64. So you can say, oh, 69 to 64 is not a big change. No, if you see the balance, 100 minus 69 is 31. 100 minus for 31 plus 51 plus 15 is 66 is 34. So from 31 to 34 is a 10% change in share. So why I'm saying this is, one, understand the landscape, that your customer wants safety and security, and he wants assured returns, which unfortunately we can't give. But safety and security, there are products within the industry which we can give, number one. So understand the customer. One of the reasons our penetration low is we've been selling only high risk, high reward products as an industry. So existing notice will know that for a variety of reasons. The excitement of the stock market giving higher returns in the sales pitch, the fact that commission structures obviously favor high risk, high reward products, give better commissions than low risk, low reward products like liquid fund. So it's a mix, but we have to fight that. If you want to get the wallet share of the customer and increase mutual fund penetration and your business, then we have to tackle. I'll come to that in a little bit. But what's the problem because of this? It is because the 60% of the Indian households are parked in low return options. So a rational being will say, what is this? Why is the Indian investor putting 60% of his household assets in low return options? So two things from this. One is, the reason is that they value the element of safety, cash in the bank locker as an element of safety. I don't care if I don't get a return. I don't care if the return is getting, if it's actually going down in value, but it's there. It's that comfort. So understand that that comfort factor is a very big importance for the investor. Second, why is he comfortable with low return? Because for him, safety, return of capital is more important than return on capital. The earlier as a mutual fund distributor, you will understand this basic thought. Well, then you will start providing him capital protected products from the mutual fund basket. So again, this is about the opportunity that understanding the customer. When you do a KYC, know your customer, that's not the filling the documents. It is to know that, is he in this 60%, is he in 80%, or is he in 40%? Because the average is 60%, right? So that's the point I want to make. And as your customers grows richer and goes up, then he dabbles in other products, because his real estate is only 29%, his equity goes to 32%. So when you catch them young, when you catch these investors young, as they grow, you will automatically see that once you've got his mind share as a person who cares for him, automatically your share will go up. So ultra rich people were ordinary people, right? Before they became ultra rich, right? So the journey of a customer is that as he grows richer and richer, is willing to take risk more and more with a proportion of his capital, right? Right. And the opportunity in terms of penetration, it doesn't matter in which state you are. This was just put up to say that except for Gujarat, which has 10%, and Maharashtra, which has about 20% because of Bombay being the financial center, the rest of the country is in low single digit. So it's just like you can throw a stone and you'll find a potential customer to go and get him into the mutual fund industry, right? So what is the opportunity then? The opportunity lies twofold. One is existing customer, higher MF penetration. Existing is already investing in equities, but is not giving his entire, he's giving a very small proportion. Second is, like I said, from 6 crore unique folios, we have to at least triple it or quadruple it over the next decade, right? So in the next aspect of mastering, I want to look at the concept that you have to look at everybody. This word alpha is bandied about, saying, oh, the fund manager didn't deliver alpha, he didn't beat the benchmark, he didn't do that, so then what do I do? But have you thought about the fact that an MMD has to deliver alpha? Now, what is this alpha? This is what you are contributing to the investor. What I mean is that when you take a customer who wants safety, if you deliver a safety oriented product which gives a better return than his alternative safety oriented product, you are delivering that alpha to him. So turn the spotlight on yourself and say, can I deliver MFD alpha? right? So that's where asset allocation is very, very important. And in asset allocation, the risk return positioning. So first, understanding the customer's risk, which you can do by asking a few questions. It's not very difficult to broadly understand. I know there are sophisticated tools available, and Asset Plus can help you with those tools. But once you understand that, that's the first step of KYC. Second is to understand that our industry has products on the low risk, low reward to the high risk, high reward side. You just have to choose the right products and the right mix of products based on the customer's risk profile and his goals. So the longer time frame you have, even a conservative investor can take a little bit of risk provided you manage it well, right? So there are various product categories which suit those. We'll delve a little bit into that now. So the point is, like I was just stressing, most important action needed is to assess the customer risk appetite and offering appropriate solutions. So first, in terms of expanding the customer base, where's the opportunity? Like I said, 60% is in loan return. That means a lot of money lies in savings bank. But we have products like liquid fund and low duration funds and arbitrage funds, which are tax efficient, almost you can say guaranteed. I will not use the word, but much capital protected, as well as giving slightly better returns than in a more tax efficient manner. The second, the FDs, which has a significant share. So 15% of the total household savings are in FDs, right? So against that, we have products like the balance advantage or dynamic asset fund, multi-asset we spoke about, equity savings, which over the medium term have demonstrated that they deliver better returns than bank FDs, even without a tax efficiency. But there is an inherent tax efficiency to all equity and debt-oriented products, as you know from the tax laws, right? So hybrid funds are the right product to match against a customer who's focused on saying, I want more FD, FD, FD. That's where you can change, right? And the new tax regime has taken away that benefit, a 5-year tax. No, as you saw, 70 to 80% of the people are now in the new tax regime, right? You're seeing that in the first slide. You noticed ELS schemes are losing their charm, right? So, but the fact is that it's not just about the fact that tax benefit has gone for 5-year FDs. Even otherwise, suppose you put an FD and you put it as reinvestment FD, right? So you put 5 lakhs now into an FD and you get about 7.5 lakhs, let's say the end of 5 years or 6 years. The fact is that the 2.5 lakh income accrues to him every month, but is getting reinvested. He doesn't get the cash in hand, but he has to pay tax on it this year. So what happens? First is that the return itself comes down. Second is you're actually suffering the taxation cash cost today. Whereas with any debt mutual fund, you pay tax only when you redeem. So that inherent hidden tax advantage is there. How many people are using that to market? Because compared to an FD, it is definitely more tax efficient, though the old debt mutual fund, that taxation which was advantage by indexation has gone away, right? It's still a more tax efficient option, right? Then the fact is that you saw the big element about gold, right? And last year, gold has delivered 67%. So, but we have mutual fund products which are incorporating gold, right? And if you look at gold's performance, you can't afford to ignore gold. So instead of, as earlier mutual fund distributors that I know, the industry itself used to shun gold and say equity is the only product, or equity and debt are the only product, don't touch gold. But customer knows this, right? Yes, 1 month there's been a correction during the course of the war because of the flight to safety to the dollar this time instead of to gold. It has a but otherwise 1 year 67%. Over 3 years it's given absolute returns of 149%. So you have to understand gold dynamics, talk to gold-based fund managers, maybe allocate into ETFs where your revenues will be, or multi-asset funds, which gives you a decent trail commission, but also gives a good blended asset allocation to the customer. The same case with silver. So now if you see what is the optimal gold allocation, right? There's this chart which I came upon, which has been done by Choice and Reuters, which says over a long period of time, 14 to 18% of a customer's portfolio in gold is the right risk reward mix. It is where the risk is minimized and the reward is maximized. You can see the green dot. Before that and after that, its value tends to go down. This is the optimal. So you can use that as a thumb rule, and that's why multi-asset allocation funds are generally at around 20%, which is roughly in this scenario, right? So that's it. Silver has the same story. You saw that last year it was 165%, and then 1 month it has also suffered the same correction like gold. But knowledge in mastering distribution, not only those mutual fund regular equities as an asset class, debt as an asset class, precious metals as an asset class, has also got to be one of the things where you have to gain your knowledge and talk to the customer and not avoid the customer, because otherwise he's just going to go and buy the gold either through a jeweler on his own, or he's going to put it in a gold ETF on his own. Okay, that's the second point I want to make. So this point I will skip now. I just spoke about it. It says multi-asset funds are the ideal. It's allowed exposure to gold, and the beauty of it is that it's a tax efficient way of buying gold. That's the way you can pitch it to your customer. So yes, there is gold here. This is what the chart says, 14-18% you have. So I recommend this multi-asset fund to you, and it gives you an equity taxation way to buy gold in your portfolio. That's the pitch, right? And within multi-asset, your skill set not only comes in talking about gold and silver, but in picking the right multi-asset allocation funds. Because if you see equity, debt, and other, and large, mid, and small. So there are multiple variations within multi-asset funds here that you need to be on top of. And you need to be on how much risk they take, which is a standard deviation, the Sharpe ratio, which is reward per unit of risk. So these are all the things that you have to master. You not just blindly sell multi-asset allocation funds. You have to understand that this fund manager has what large cap. There's a fund which has only 22% large cap in the equity component. Another fund has 52% large cap in the equity component, right? So the same goes with gold and silver. It's limited to 20% by SEBI, but within that itself, there is variation in terms of how much they do others. You can see that it's all broadly, but some have taken as low as this. So the point is that understand that multi-asset allocation fund before offering it is also an important part of mastering mutual fund distribution. Now, that was I talked about to pitch to newer people, because like I said, gold and FDs, and these are the main pitch. So which means what? A lower risk product has to be a first approach to a new to industry, new to equities, new to mutual funds customer. Lead with the low. You might think that it's not worth my time, but just like when banks or anybody else markets a product, there's something called as a loss leader. They go and take a hit to get the customer in. You know that from the telecom pricing, how they do that. You know that in housing loans, very banks have offered 6% only for the first year and hooked the customer. So look at it from that perspective. You're building a long-term relationship with the customer. Initially, if you sell low trail commission products to him, but which suit his risk profile and his addresses his fear and his need for safety, that's the way you have to adopt it and go. Okay. So now in this case, whatever you have, the alpha generation was, first of all, let's look at a passive investor who says, I just want to fill it, shut it, forget it, right? Who says, I'll buy this stock and I'll retire with this stock. I don't want any mutual fund and all to come and complicate. So I just wanted to put this slide up to show you that the Sensex 1986 was a census 2025. Top companies, top 30 companies in the country, right? The black in the overlap in the middle are the only companies which were in the Sensex in 1986 and are in the Sensex today. So just buying a company and saying, hold it, this means the probability that your company will be there 30 years later as a high performing company to deliver value to you is not a given. So this is one of the pitches you have to use to talk to a passive investor who says, oh, I bought ITC stock, I'll retire with it. I bought Infosys, I bought Reliance, I want to retire with it. No, it's not necessary that good company today remains a good company for 30 years and remains in the top echelons of the industry for 30 years, right? That's the point I wanted to make. And of course, hazards are investing now, you know that very well. I don't want to take names, but there are a huge number of stocks which over the last 5 years have delivered less than 5 to 2% returns. And these are top quality companies. So because stocks, I know Warren Buffett has said, buy good businesses, not buy stocks. But the point is that good businesses, when they are priced to perfection, don't deliver value in the stock market. There's always a battle between price and value. Value comes from the good quality of the business and the earnings. But if that is known to everybody, then everybody has already bought it. There is no super profit left to make. And super profit gets made only when you discover something before it has happened, or if discover it before others find out. So that comes from active fund management and expertise. Okay. So let's next is you come to an active investor who's wanting managing his portfolio actively, right? Now in active, he can either do active funds or passive funds, right? This is a customer who's already, we're not talking about new customers any longer, right? So now when you look at it, a blend of active and passive is a compulsory thing in these days, because large cap funds, because of the nature of the construct, because you have EPFOs and FIIs all buying large caps, and I just mentioned that the top stocks haven't delivered the best returns. So better that the passives are done there. Now, if you keep pushing active in large cap, for example, you will find yourself suddenly in a point of time where they are underperforming for a period of time and hard to answer. So in the larger end of the cap curve, be open that at certain times and situations, passives are a good addition to the product. Again, it's a low return product from your perspective because of the low trail commissions or zero trail commissions almost in the case of ETFs. But you have to look at it overall as a value proposition to the customer. Don't try to make money out of each product that you sell to the customer, right? And then you have in the passives this thing called smart beta, which are the momentum funds and the value funds, the low vol funds. But there again, it's not just buy, shut it and forget it. If you see here from 2015 to 2025, the leader for that year had kept on changing. 1, 2, 3, 4, 5 times momentum was there. 1, 2, 3 value was there. 2 times low volatility was there. So your knowledge again in understanding these themes in the market and talking to the fund managers saying which theme is likely to do better in choose of in the passives. If you do smart beta passives, then it's a slightly win-win situation because the customers desires to be active about it. You're managing it, doing these things. Second is naturally your trail commissions and others will be slightly better here than from a passive fund. Obviously, not as good as a pure active fund, but somewhere in the middle. So this is a big thing for you to get on top of. But here it's active management from you. Yes, active management equal to churn. So do it with care, right? Over churning is also not good. The customer ultimately may end up going nowhere. But to that active investor who wants something to be done, he says, why are you simply sitting there, not doing anything? It's the emotions of the customer that you're tackling with this product range, right? Then your cap curve allocation. You have to manage the large, mid, and small cap proportion based on the customer's risk appetite, based on how long away is his goal, and all of that. You all know the basic rules, right? The shorter the tenure, large caps are better. The longer the tenure, more small caps. The more moderate risk he is, more large caps in his portfolio. The more high risk he is, the more small and mid caps in the portfolio. But broadly, I would say that history tells us that the sweet spot is in the mid cap because it has a blend. Because SEBI's rule says only 60% needs to be there in mid cap. So fund managers are happy to blend in either large caps or small caps into mid cap funds. So they are a sweet spot. So I would say that you give a significant larger proportion to mid cap and then play with the cap curve around that manner, right? So one of the things I wanted to show you here is that in the large caps itself, when you pitch to a new customer, right? This is the key that Nifty 50 itself on TRI, 70% of the time, if you take a 7-year holding period, has given more than 12% returns. So these are the standard toolkits, and I have a set of these slides which I'll show you a bit later, right? Now I mentioned that mid cap should be the core part of a long-term investor's portfolio. Now again, mid cap funds are not all that high risk because you look at the risk and the reward here, you can see that across the industry, most of the mid cap funds have been able to deliver returns far in excess of the risk. So that's why I call it a sweet spot, because if you look at the return profiles of the mid cap funds versus the risk profile, clearly in almost all the cases, they're able to deliver an alpha in terms of reward over risk, right? But at the same time, when you go to small cap, there is a range of risk with the small cap. So don't bucket all small caps for one. For example, what I've shown here is two sets of things. That what is the quantum of micro caps in the small cap fund is also key, because the universe is beyond the 251 up to 4,000 or 5,000. So different fund managers will have a different approach. So you have to assess that the longer the tenure, the more you can afford to have a greater micro cap concentration. But if he's taking greater micro cap, it also means that you have to constantly track the performance based on the business cycle, and maybe you need to churn it out of that fund into going into something which has greater proportion of small and lesser of micro. So these are all the things and thought process I want to leave with you on where you have to develop your skill set, right? And then you come to the new product category called specialized investment funds, which you're all by now it's aware. I prepared this slide quite some time. You all know that it's nothing but the regular categories with 25% of shorting capability, right? So naturally they are higher risk because of that. But the way the fund manager use that shorting capability can be to reduce risk. So SIFs are of both types. There are high risk, high reward SIFs, and there are SIFs which use this shorting capability to reduce the risk also. So accordingly you can do. But since the minimum is 10 lakhs, your customer should be having at least 1 crore for you to allocate, let's say 10% of his portfolio. So bear in mind that when you allocate this product. I'll skip this set of slides because by now you're all experts, I suspect, in the SIF category. The other thing that you should not ignore is the international. And last year was a classic case. Right? India large caps delivered 10%, but markets like Korea and Taiwan and all have delivered 40-50%. So the second aspect is that rupee depreciation hurts you as a domestic portfolio, but benefits you when you have an international. So international asset allocation is a critical part. Every customer, regardless of his risk profile, should have some portfolio allocated to international as a risk diversifier. Yes, international is higher risk, but when you're blending it into a portfolio, right, there are times when India is not doing well, they do well, they're actually reducing your overall risk of your portfolio. Though standalone, they are higher risk. Please understand what I'm saying. So international addition is important. So it's a conservative-ish customer, put 5% of his portfolio. Then aggressive, put 15. Don't necessarily go to 15 or not more than 20, but play within this band. But it's important because it helps you to show A, your value addition to the customer, and B, overall on a risk basis also, you're reducing the risk of the customer, right? So if you there look at it, year on year, which countries' markets have done better has been keeping on varying. I just showed this to you to show you from the color itself, you can make out that no country has been consistently on the top, right? And it keeps varying. So you also have to choose. I know because of the RBI regulation and SEBI following that the number of mutual funds that accept overseas investment has come down dramatically now. But there are gift city options. There are LRS investment options coming up. So a lot of place for you to still play the international theme in your customer's portfolio. Then we come to the fact of sectoral funds, right? Yes, there are huge amount of sectoral funds. Last year, in fact, 2024 and 25, there are huge amount of sectoral launches, right? And if you see that, most inflows at that time were all in sectoral funds because the market was booming and sectoral funds were delivering huge returns. There was excitement. But you have to be very careful. They're extremely high risk and high reward. And how you choose them, again, if you look at it, strong earnings growth for some, but others are less. So choosing sectoral funds, if you want to put, it should be only for your high risk, high reward customers, because they are not automatic risk diversifiers. Unless you choose a blend of sectoral funds which are opposite, consumption and infra and banking and defense and all of that. If you're going to go down, the customer has to have that risk appetite, number one. And number two, you have to be on top of the ball in talking with the fund managers and experts to understand the outlook for the sectors, because by nature, sectoral funds means you have to churn the portfolio. There is no sectoral fund which is just blindly buy and hold. Okay, because sectoral funds, there's a time for entry and there's a time for exit, right? So bear that in mind in using sectoral funds. And broadly, if you want to look at sectors which are coming up and upcoming, I've just listed the 10 of them: alternate energy, EVs and batteries, AI related services, e-commerce, semiconductors, the space as a sector, nuclear fission as a sector, renewable energy with storage, biosimilars, biopharma, and cybersecurity. These are all the new sectoral themes will come. I'm sure there'll be fund houses launching and you get prepared for these. I'm not talking about the existing finance sector versus consumption, but these are things where your knowledge, because customers will be curious and active, and so your knowledge, whether you pitch a product or not, your knowledge has to be on top of the thing. So that's what I've wanted to put out. And the next one is the most important, I would say, is fund manager selection. Why do I say? At some point of time, I've taken this data. I'm sure that we can update it, but the difference between the best funds and the worst funds is as high as 30%, right? So from that point of view, how you choose a fund manager based on his track record, based on this, is very critical. It's a skill. There's no one rule fits all. You got to understand the customer thought process, understand the fund manager thought process, and look at it and put your own knowledge on. The fund manager, as long as he's got clear in his thought process, but he can't guarantee you success. So you have to understand what the fund manager is doing and then do. Don't just say, oh, I've given it to the fund manager, he has not delivered. No, customer doesn't know the fund manager, customer knows you, right? So from that point of view, there are industry, because of its explosion, has had a lot of young people coming from the analysts into fund managers. So there's a huge amount of new fund managers. Now you can say the young gun can pick faster, better stocks and do, but the experienced marksman also is important. So blend those also. I'm just saying, when you look at your portfolio of customers and where they're putting the money, make sure there's a blend of young fund managers with who are having exciting new thoughts versus experience. That's all I'm talking about. And when you then go, one of the biggest mistakes that we do is that we pick the best performing funds as the winners. So I picked up this slide, right? And if you look at it, you clearly show you that how the rankings, and that's why the numbering of the funds is not the name funds. It's just A, B, C, D, E, F, G, H, I, J. 2014, which was 1, in 2024 is 87th ranked. Right? In 2014, which was 10, is 60th rank. The one which is at the 18th rank is Fund 9. But the top, they are nowhere in the top. The top are those which are outside of the top 10. So this buy and hold, right, from a fund perspective, it's good in a way. But if you're just choosing a very good fund and say, that's why I'm going to buy and hold, it doesn't work. Right? So the point is that you have to blend the performance with the thought process of the fund managers on why he thinks he will outperform over the next 5 to 10 years, and then choose him even if he currently isn't in the top 10. So first lesson. Next, if you've picked funds based on 3-year return rankings, okay, and then you see the funds which are in Q1, 38, 40, 45, and after 1 year, you see only 5 of them are in Q1. That's right. So the persistency percentage is only 12%. So top quartile funds are not consistently. So while these data are very useful to you, take them with a big pinch of salt. Try to understand why that fund has performed so well to be in Q1. So that then, based on what you understand about the economy in the markets and you're discussing with other fund managers, you will say that, is it likely to sustain, or has he taken a very good bet on a sector and that has delivered? But who knows, that sector may underperform. So he's not diversified enough. He's concentrated on a sector, hence he has delivered outperformance. So just don't go by those numbers. I know a lot of MFDs tend to do that. That's why I'm re-stressing this point, right? So I want to summarize my discussion with what I feel is an MFD toolkit, especially very useful to you when you're trying to onboard new customers. These are the critical set of slides you should tell them before they enter into the equity market or mutual fund industry through you, right? And I would say even for existing, it's very useful to keep this. So first is how different start points, because everybody is worried, oh, is it the right time to enter the market? Is it the right time? When you're going through the SIP route, and this particular chart has taken 7-year SIP, rolling returns, if you had entered at all-time high, your minimum returns was 5%, your maximum returns were 18%. So even if you entered all-time high, there's an 18% chance that your SIP in 7 years will deliver 18% per annum. If the index has already rallied 20% in the last 1 year, even then, the maximum returns have been 19%. And after the index has fallen, so the key point here is that the start points really don't matter when you're getting a customer through an SIP, right? And this is a study done over a 20-year period, okay, for a 7-year SIP, okay? That's the first point, to pitch to a customer the SIP, that this is the one. Second, why time matters more than timing. Because when the war situation is there, that's when people try to avoid, but those are the best. So if you look at the Nifty 500 index TRI returns, if you miss the best days in that entire period, then 17% would have been, right? If you missed 50 days, your returns would be only 4.7%, right? So the point is, if you have stayed invested for the period, regardless of whether the market is correcting or not, you got a 17% return from that index. But if you miss the best 50 days, your return went from 17 to 4%. So time in the market is more than timing the market. This is a very good slide to keep with you, to tell them, when you commit to me for the long term, please stay the long term. Don't keep questioning me that, oh, war has happened this time, I want to redeem, take out my money. This is what will happen to your returns if you do that. Next point. Lucky investor, unlucky investor, regular investor. Nifty 500 in the long run. What is the period? 1995 to 2025. 30 years. Okay. What has been the exercise? A lucky investor got 16%. A normal regular investor got 14.7%. The unlucky investor got 13.7%. So it really doesn't matter. If you're committed for the long run, you are assured of healthy double-digit returns. And the difference between the best and the worst times there from a lucky perspective is, what does the lucky investor mean? Just read that so that you can understand what you mean by lucky, unlucky. It's not about astrology. It's not about Rahu Kalam or something like that. No, lucky investor invested at the market's bottom, right? Unlucky investor invested every at the market top. And the regular investor simply invested the first trading day of each year. Simple, right? Because the guy who's at the market bottom thinks I'm very lucky, oh, I've got the bottom. That difference is only 2.3% between an unlucky investor who is the bottom top, if you have stayed long enough for that 30-year period. So again, a very important part of your toolkit, I would say. Next is telling the investor how he should do, and which is what you're going to help him with. What? First, picking the fund with a credible track record for the long term, right? Don't take 1 year returns, 2 year returns. Say the track record must be credible over a long term. Which is what you're going to help him do. Second, as we showed from the previous slides, equity market volatility tends to even out over the long term. This is what you have to tell the investor. And third, using SIPs lowers the buying cost during market volatility. Fourth, stick to the asset allocation which he co-designs with you, right? Which matches his risk profile. Stick to that. Rebalance, book profits in a rallying asset, add to correcting assets, right? That's same rupee cost averaging, but doing it across asset classes in a way. And you have to rebalance at specific intervals based on how the economy is going. You have to remain in the market for the long term, but you can rebalance based on your expertise and guidance that you provide to him, keeping the asset allocation, because his own goals may change, his own risk profile sometimes changes, because initially he's frightened of the equity market, later gets more comfortable. So this again is important, right? So finally, as a takeaway for investor this call, but it's important that you understand that and talk to them about this, is first, point-to-point returns can mislead. Do not use that. Markets favor certain styles in certain periods only. So they are not all-time styles. Third, check rolling returns over longer time frames, not point-to-point returns. And check those rolling returns which are based on long-term daily averages, right? You can use quarterly and all that. They're not as efficient. Use daily averages. And as what you just spoke about, look at the fund manager team and the investment process. Track the fund manager's outlook and not just his past performance, and try to gauge his investment philosophy. And finally, you have to understand, learn, and educate customers about the risk ratios, it's a sharp ratio, shorter ratio. So he also understands what you mean when you say, I'm choosing a low risk reward for low reward fund or a high risk, high reward fund. And by doing this, the asset allocation diversification, I'm going to bring down your risk. It's all these ratios, which so educate them from your end, but first educate yourself on that, right? On that note, just to conclude, a huge opportunity lies from expanding the customer base. So for inquiring a new customer, these are the things that I request you to focus on. Build your personal brand, competence in your field, writing blogs, regularly speaking in public forum. Use marketing initiatives, put up hoardings which are pictured in your locality. Use radio as a medium to promote. Leverage your peer groups, your college, your alumni association, your club, Rotary club, whatever, to reach out to audiences. Technology is absolutely critical in this day and age. So beyond your geographical location, your customer's brother will be somewhere in Guwahati. Enroll him as a customer in the digital world. Corporatize yourself without losing the human touch. All of this, put yourself as a limited company, do corporating, but make sure that you are the face of it and the human touch is there. And catch them young. Your customers' children are the first ones who expand new customer base. Is get your customer children at a young age on board, right? On the penetration existing wallet, what do you need to do? To first remember that ultimately, all said and done, you're in the trust business. And so you have to win his trust. You have to be his life financial coach. And you have to deal with the entire gamut, including zero revenue bank deposits. You have to recommend them. The zero revenue for you, but understanding his risk profile and saying, okay, sir, put this much, it's safe, it's this, it's important. And you have to get to estate planning and will writing and all of that also. And so you have to use partnerships there, tying up with lawyers, tying up with legal firms to deliver those. And with the existing customer, master of technology is not an option. You have to become a master, but don't overuse technology. Dumping data, market updates. This is essentially the WhatsApp university at play. Customers get very quickly turned off with that. Then, of course, your knowledge and your qualifications are important for him so that your phone call doesn't become a missed call. Arey bhaiya is again calling. What is it? But if he knows that from that call he can learn something, understand something better, then he will pick up your call. But for that, you have to make yourself that much better. And you have to leverage the AMC's expert. There are economists in AMCs, there are fund managers, there are product specialists to enhance your credibility and reach through regular Zoom low cost physical events. Keep customers engaged in that way with your connect. And obviously you have to create a succession plan because customers are knowing that they may outlive you. And so what is going to happen after you, right? So to that extent, communicate an obvious succession plan. Persuading your kin to join the business is the best, obviously, because what happens after you is important to address for the existing customers, right? So with that, I will conclude my speech. Long-term growth prospects and all, I'll take long term. I think it's already been close to about 50 minutes since I spoke. I'll now hand the floor over to Sukanya to talk to you a little bit about AssetPlus and how they do. So shall I stop sharing and you can now start sharing, Sukanya?
Yes, yes, sure. Thank you, Sunil. All right. Thank you, everyone. Thank you, Sunil, for such a wonderful session, for all your suggestions and advice. I'm sure this will be valuable not just for people who are already in the mutual fund distribution industry, but also for people who wants to enter the industry and start off with their own business. With that, I'd like to now tell you how the people who are planning to enter the industry they can, and for those of you who are already in the industry, just stay tuned because I'll be talking about how AssetPlus can help you scale up and grow your business. So to become a distributor, there are three very simple steps. First thing, you have to appear for the NISM 5A examination, which is held by National Institute of Securities Markets. You have to clear the examination. After clearing the examination, you will have to get your ARN, that is your AMFI registration number, which is basically the license to practice as mutual fund distributors in India. The cost of NISM 5A is 1,500 and the cost of getting your ARN is 3,500. And to help you clear the NISM 5A examination, AssetPlus Academy will support you through and through. Now, the third step, of the final step, is to empanel yourself. Whenever you get the ARN, you have to empanel with any national distributors like AssetPlus or as many number of AMCs as you want. Now, how AssetPlus can help you become a distributor? So first thing is we will help you clear the NISM 5A examination. For that, we provide several courses. So first is our 14-day guided training course. So through this course, we give you live training sessions through experts, which cover all modules of the NISM 5A. Along with that, there'll be Q&A as well as mock test sessions, ideal for anyone who prefers a structured way of learning. We also have a self-study course. Basically, this is for anyone who wants to learn at their own pace. So you get access to pre-recorded classes, and these will help you understand the concepts and the mutual fund related anything in the mutual fund related industry much better. This too includes mock test as well as a lot of support from the from AssetPlus Academy team to help you register for your NISM as well as your ARM. Additionally, we also have a third training program that is a one-day live workshop. So this is basically for people who are wanting a live class. So we are visiting over 25 cities in India to carry in-person sessions that are led by expert faculty. These are basically intensive preparation for NISM 5A certification to help you clear the NISM 5A exam, also interact with the AssetPlus Academy team. This too will include mock test and full support starting from NISM registration to ARN registration as well as empanelment. Now, once you have cleared the exam, there comes your next step. After clearing the exam, the first step is to registering your business. You have registered your business. Now you will need a toolkit or infrastructure for developing your business, and that's where AssetPlus is going to help you. AssetPlus is India's leading fully assistant digital management wealth management platform. It is designed to help MFDs manage their entire business smoothly from one single place. Currently, we have more than 20,000 distributors who are already partnered with AssetPlus, and we process over 5 lakh transactions every month. One very special thing to note about AssetPlus is that both our founders, Mr. Vishrant Suresh and Avnish Raj, they started their careers as MFDs themselves. Therefore, they have experienced the challenges faced by MFDs firsthand, and that's why they built AssetPlus to solve those challenges, to cater to those challenges. And apart from this, we are also backed by some of the most respected names in the finance industry in India. For example, Nexus Ventures is one of our investor. Then Nitin Kamath of Zerodha and Rain Matter Fund, Bhupinder Singh of the Incred, as well as Eight Road Ventures are all our investors. So you can be completely assured that you are partnering with a platform that is trusted and future ready. Now, talking about the platform, we offer both a partner platform as well as a client platform. So basically, this is so that you and your clients have complete visibility as well as a seamless experience. And now, unlike other platforms, we don't just give you a platform and leave you on your own. We will make sure that you make the most of our services. So Asset Plus supports you at every stage, starting from growing and scaling your distribution business. Now, to become a distributor, one very important thing, as mentioned by Sunil as well, is that you have to stay updated with the industry trends and everything. Because you're not just a distributor, you are a financial guide. And for that, we have created a comprehensive resource hub through which you get access to YouTube videos, webinars, expert sessions, multiple newsletters, and many other things just to help you understand the industry better, train as well. We also provide certain training sessions because if you are starting off with the we are just starting off with the mutual fund distribution business, then you will obviously need to understand how the distribution industry works, what are the things that you need to do, what are the things that are necessary for you. So for that, we provide multiple training sessions, for example, masterclass, MFD starter kit. So all of this come under our resource hub. So once you join Asset Plus, you get access to all of this. Now, apart from resource hub, we are also going to help you build your visibility. That is, you will need to market yourself better so that you can put yourself out there more to your customers, to your clients. So for that, we are going to help you create video content. Then if you want to host IAPs, for example, corporate events or investor awareness programs, offline, online, anything, we are going to help you host these as well. If you want to build a professional website for your business, we will help you build a professional website as per your requirement. Then if you need any kind of physical marketing tools, for example, posters, banners, hoardings, visiting cards, anything, we are going to help you with all of that, with publishing and creating all of that, be designing or making them. Everything you will get basically at one platform, everything at one complete platform, a complete ecosystem to help you build your business as well as scale up your business. So after this session, you will receive an email with the registration link. Once you sign up, our team will connect with you and guide you through the entire process. And with that, I'll be concluding today's session. I'll open the floor for questions. If you have any questions, would be taking them up. I don't think we have enough time to take all of them, but we'll try to take as many as possible. Sunil, are you there?
Yeah, I just switched off my video. Okay.
Oh, no worries. Yeah. So we have a few questions, so we'll just take them up real quick. So the first question is from Mr. Ashok Kumar. He's asking, what is the percentage of allocation that can be kept for international funds?
I was saying that a max of 20% is what I suggest, and then I said 5 to 20 based on the risk appetite. Compulsorily 5% should be there, I would feel, but don't exceed 20 too much, because end of the day, India is the long-term growth story and it will still deliver. So 20% of India international should be a good allocation.
Okay. The second question is, what is the response of SIF among the customers or market? Would you suggest it to be added as soon as possible through SIF exam qualification?
I don't know about the response of this. I'm not an active fund manager. I retired 2 years ago. So you can get that data from somewhere. But according to me, yes, you should qualify yourself, because as your customers grow, they will become aware of the product and they will ask you. So if at that time, customer says, nahi, mujhe chahiye, and then what will you do? If you are not qualified, you cannot even sell it. So selling is different, but first getting yourself qualified is important. And it is suitable for a particular type of customer, the high risk, high reward customer. It's suitable for a customer who has a minimum of a crore portfolio, because you shouldn't put 10 lakhs in one single category or fund unless 10% more than you cannot do. So I would say it should be at least a crore pati. And but yes, your qualification is absolutely critical. On how is the response among the market and customers, I don't know. I'm not in the industry.
Thank you, Sunil. I'd just like to add one point to that question. So we host multiple webinars on SIF as well. So if you're interested, you can join those webinars, and you can get your all the information regarding SIF as well as how it is doing in the market. With that, I'd also like to let you know that we provide NISM 13 SIF examination course as well. If you're interested in investing in SIF, let us know, then we can help you with clearing the examination and get started with the mutual fund distribution process. So we'll move on to the next question. Okay, so this is for AssetPlus. If AssetPlus is a platform for MFDs to manage their clients, or is it more than that? I'll be happy to take that question. So definitely it is not just to manage your clients, it is more than that, because at the end of the day, managing your clients is not just the only thing that you need. As I mentioned, you have to scale up your business, you have to know about mutual funds, you have to understand how the industry works, and for that we are going to give you complete hand holding, so that you have that support throughout your entire mutual fund distribution journey to grow as a mutual fund distributor, not just become a big mutual fund distributor, but become a successful one at it. So yes, it is more than that. And to know more about it, as mentioned before as well, we are going to be sending out emails. Register yourself and we will be reaching out to you. So the next question, alongside mutual funds, what all other products must we know about and suggest the clients to increase the wallet share and provide real life financial solutions?
So obviously, I don't know whether you consider ETFs as mutual funds, but yes, ETFs are something you should know about. Like I said, again, international, you should know about the Gift City and the products that they launch, because it's not technically in the mutual form. You must know about PMS and AIF products as your customers get wealthier and more comfortable with risk. AIF and PMS products are critical to know about. You must also know about company fixed deposits. But sometimes there are very good companies which give you fairly decent returns. Like I said, you have to ultimately look at what are the customer needs you should provide. You should be a financial supermarket. So even though you don't make much commission, bank deposit you will make zero commission. But in private company deposits, they do give commission. So there is a source of revenue. So you should be on top of those also. And also, I would say investing in the bond market. Now you can directly invest in the bond market. So interest in customers can be put money in G-Secs and other things by you. So that's again a product that you should be aware of in directly investing in RBI bonds or in GSECs. So there are a whole host of products. And apart from just selling products, like I said, will writing, estate planning, those kind of things also you should be on top of, because succession planning for your customers is also something that you will do, which will increase the wallet share. And of course, I forgot to mention, insurance has to be a key part of your product offering, because term insurance, right, which takes care of the exigencies, car insurance for his car, and personal health insurance, all of these are critical. And that only shows your complete commitment to the customer.
So we'll move on to the next question. So Mr. Harendra is asking how many funds a person should take.
There is no one rule for that, because ideally people say it should be about 4 to 5 funds, but I find that all customers have something like 40 to 50 funds in their portfolio. So every new customer, every new time a new NFO comes, you do. So it's very hard to say, but I would like to put it in maybe categories. You should have at least 5 to 6 categories in your customer. So liquid fund is one category, short-term debt and liquid funds one category, hybrid is one category, SIF is another category. Then you have large cap and mid cap and what a flexi cap. So about 5 to 6 categories of funds. Now within that you can choose different styles of fund managers, right? So even within flexi cap, somebody will be managing more the large cap oriented flexi cap, somebody will have an outlook. So the outlook of the fund manager is also different. It's not just the portfolio. So technically, I would say the rule of diversification says that 20 is the max diversification, beyond which the effect of diversification slowly goes away. And most mutual funds have 50 to 60 stocks, because that is where after that it loses value of diversification, right? So use that in an according, but I don't want to give a hard and fast rule that this is the number of funds that you need.
This next question is opinion about aggressive hybrid equity funds.
Well, they are fixed allocation in the sense that they have to have minimum 60% in equity and balance in debt. So they are fixed asset allocation products. They are useful to the extent that you are very clear about asset allocation and you are very clear that this much equity, this much debt, because the balance advantage is the competitor to this. There, the fund manager decides how much in equity, how much in arbitrage, how much in debt. But here, it's clear, I don't think they can do arbitrage. It's only long equity or debt. So, but what I've seen in the market, when I last with Sundaram 2 years ago, is that most aggressive hybrid equity funds, the flows are coming in where they're trying to give some kind of a regular dividend. And these are being pitched to retired people who need regular income as an alternative to putting into a bank or an annuity kind of a scheme, right? Is what was that. I don't know how far that is now. I'm not in touch with that part of the industry since I'm no longer with an AMC. So I would say that it's a fixed asset allocation as opposed to a dynamic asset allocation of this. So if you're very confident about asset allocation, you can look at that. If you're clear that in your customer portfolio, you want this much debt and this much in equity, then you can choose.
Thank you, Sunil. So the next question, uh, this person is asking how MFD can submit application for his client who want to invest via check. So I think I can take this one up. So basically, AssetPlus has the feature to invest via check for their clients. So basically, you can just ask your clients to visit their nearest bank, submit the check, and the rest of the processes will be done by AssetPlus. To know more about this, I'd suggest that you register with us. I'll get in touch with you and help you understand how the investment process or how the transactions work in AssetPlus. We have multiple transaction methods, so I'm pretty sure each one of you will be beneficial for you. We'll move on to the next question. So this person is asking, putting lump sum in arbitrage or overnight funds and doing STP weekly to vanilla funds like multi-asset funds is a good idea.
Not really. I would say if you're going to put them and stagger it, choose a higher risk product. The multi-asset fund is a diversified hybrid category, right? So there you can put lump sum straight away. But if you're going to choose a mid cap or a small cap or a large cap or separate category fund, then this is a very good idea because you're staggering it and taking advantage of the volatility. But in a multi-asset fund is anyway diversified across debt, gold and silver and equities, right? So by staggering your access to that, you're only over diversifying. So I would not recommend it for the product that you have mentioned as multi-asset fund. But if it's for a small cap fund, well and good.
Okay. We have next question from Mr. Chetan Bhatia. He's asking, can we help clients with loan consolidation and ask for a fee against the planning, or maybe work as a DSA for helping in loan consolidation? He also has another question. Can credit cards also become a part of the arsenal?
Well, I would say don't dilute yourself. You're a person managing his money. Now, if you want to dilute your efforts because of doing loan consultation, customers hesitate to pay a fee. That's why the whole RIA business model hasn't taken off. Less than 1,000 RIAs in India, and customer hate to pay fees. So I don't have a very confidence that you can get him to give you a fee for loan consolidation and all of that. Because already if he has too much loans, he's already suffering the loan burden, he's unhappy. On top of it, you want him to give a fee. I doubt if that will work. And again, credit cards, I would say stick to the investment to insurance field. That build your expertise and stay there, and about managing his wealth even after he dies, right? Estate planning. But getting into too much of these things, the cost involved, you'll have to have a personnel to handle that. And what credit card, what are you going to do in the credit card? You want to get a fee from the credit card company going and marketing a credit card. So I think that stick to investment side. These are all the borrowing sides, right? So I would say your bandwidth will get suffer, your existing clients will suffer because you're spending too much time with this client on loan consolidation. So my suggestion is to not to stick to be an investment side professional.
Okay. Thank you, Sunil. There's one question from Mr. Atul Khurana. For your question, we'll be reaching out to you. We have noted down your email ID and phone number. We'll be reaching out to you and answer the question that you have. With that, I think we can end today's session. We do not have any other questions. So, thank you, Sunil. Thank you for all the advice, for taking the time to answer all the questions so with such patience. I hope that today's session has been helpful for all of you. I hope it adds value to your journey. We will continue to bring such more webinars, more expert sessions, and more resources to support you through your distributor journey. Thank you once again for joining us today, and we look forward to seeing you all once again in our upcoming session. Thank you, Sunil. Have a
Thank you.
great weekend. Thank you,
All the
everyone.
best to all of you. Thank you.
Thank you.